Welcome to the first video in what will be a short series about what the city does, who the key players are, and why they exist. And in this first video, I want to take on the role of banks. So here comes a snapshot summary of what banks do and where they fit into the bigger picture. Now, the city itself, and banks are a big part of it, basically does one simple job. It brings together people with money and people who need money. So in a nutshell, it links investors, that's people prepared to put money in the hope of getting a return, which I'll call I. Now, there are a few rules of thumb there, but one of the key ones is the more risk you're prepared to take, the greater that return will be, and so on. And on the other side, you've got people who need capital. So you've got borrowers looking to take money out, if you like, and pay a price for doing so. All right. On the left-hand side, who might those investors be? Well, they can be loosely divided into two groups. There are the institutional investors, for example, pension funds, looking to make a return on the money that's given to them by savers. And there are retail investors, for example, like you and me, looking to make a return on our bank accounts or from shares, bonds, and so on. On the right-hand side, big borrowers include the government issuing IOUs to fund the gap between tax receipts and all the things they have to pay for, defence, education, and so on, and corporate borrowers also issuing IOUs or issuing shares. But essentially, the city brings those two parties together, and that's worth remembering, no matter how complicated the institution or the product you're looking at. That basic purpose is what it's all about. And of course, the people in the middle are doing it to make a profit. So there are your basics. Let's take a look at banks. Now, banks can be loosely split into two types, retail banks and investment banks. I'll leave central banks to another video. So on the left, retail banking is the age-old practice, it's been around centuries now, of accepting money from savers and offering, as most of you all know, a fairly low return, and lending that money out again at a different maturity typically to people who want to borrow it. That could include people like you and me looking for a mortgage, could include companies looking for a loan, okay? But the basic principle is quite simple. Banks aim to pay less on the deposit side of the equation than they generate from lending those funds out. And retail banks tend to be large because it's a kind of bulk business, if you like. So the likes of HSBC and Wells Fargo, pretty large businesses focused heavily on the retail side of the market. So far, relatively straightforward. All right. On the right-hand side, things get a little bit hairier. We've got the investment banking side, and of course, it's not true to say anymore that you've got definite distinctions between retail banks and investment banks. There are some pure investment banks around, like Goldman Sachs, for example. There are some mainly retail banks around, but there are quite a few that kind of do a mixture of the two, like Barclays, for example, which has both a retail and investment banking arm. Now, it's the investment banking arm that expands quickly in the good times, contracts rapidly in the bad times. So what are they up to? High risk, high return stuff. And I want to just give you a flavour for what investment banks do on the right-hand side in the rest of this presentation, just by looking at 4 or 5 key activities. Not the full list. If you walk around a bank and look at the signs above people's desks, you might see more lists and you might see different names, but it gives you a flavour. Now, the first two I can tick off relatively quickly. Prop or proprietary trading. That is gambling with the bank's own money, essentially. It's given a rather grand title, but that is traders at the bank taking risk by investing the bank's money in bonds, commodities, currencies, shares, whatever it happens to be, in the hope of generating a return. Prop trading desks, as they're sometimes known. New issues. More specifically about IPOs, coming up in a future video, but that is the process of helping and advising a company that's coming to the market for the first time looking to raise capital. They need advice on the timing of a new issue of shares, the price. They need help with the regulatory issues, keeping the stock exchange happy, and they need help contacting investors who might buy the shares, and so on. So new issues is a fairly big part of what some banks do. Then we've got some more jargon. We've got market making, corporate finance, brackets, mergers and acquisitions, as a good example of what corporate finance is all about, and asset management solutions, as I've rather grandly called it. And I'll just give you an illustration of sort of one solution. So solving problems for clients, both institutional and in some cases retail. Okay, so let's take those last three. Market making, very common piece of jargon. What do market makers do? Well, Quick story here. You've got a client on the left, retail or institutional, looking to buy some shares. So they normally contact a broker. More about brokers in a future video, but they contact a broker. And that broker essentially has two ways of getting a deal done in shares on behalf of their client. And of course, they'll take commission in the process of doing so. Number one is a purely electronic trade. So a broker might look at their screen, say, great, all I need to do is pump this order to buy shares into the market, and it will be automatically and anonymously matched with someone looking to sell shares at a competitive price. And exchanges like the London Stock Exchange specialise in running those electronic order books that people all over the market can use to buy and sell shares. But it works best for the most liquid, popular shares. For slightly less liquid, slightly less popular shares, or where there's a kind of awkward deal instruction from the client, a broker might contact a market maker. And market makers are a bit like, if you want to see it this way, second-hand car dealers. They won't thank me for making that comparison, but essentially what does a second-hand car dealer do? Holds a stock of cars, has a buy price and a sell price. All right, the more dealers there are in your area, essentially the better deal you can probably get as a car buyer, and you'd approach them looking to do a deal in a particular car that you want. While a broker can approach a market maker in shares, they run books of stock. If the share is relatively difficult to trade, there'll be a big gap between the price at which they buy and which they sell as market makers. If there are more market makers or it's more liquid, that gap will narrow. But slightly awkward deals in sometimes less liquid shares can be routed through a market maker. And market makers also, by the way, help to create, hence the name, the market that allows brokers to do the other thing, which is get an order done sort of electronically without having to pick up the phone necessarily. So there it is, electronic execution and market making. Now, M&A, what's that all about? I said corporate finance. Well, here's one example of what that could mean for an investment bank, mergers and acquisitions. Let's take a quick example. You've got shareholders in company A, right, on the left-hand side here, and shareholders in what's going to be the target company, company B, out on the right-hand side. And basically, company A's directors decide they want to make a bid for company B. Cash is a good thing to bid in return for the shares of company B. All right, and if they get enough of them, they'll take control of the company, and that's a takeover. Where does an investment bank fit in? Well, you could have an investment bank basically advising on the left-hand side and potentially advising on the right-hand side. And the sorts of things they make a fee for doing, they often take a percentage of the amount paid, for example, out as a fee, is advising company A again on the timing, the pricing, any regulatory hurdles that might have to be crossed. Company B might want advice on defence tactics and so on and so forth. So there are plenty of ways for investment banks potentially to make a fee out of things like mergers and acquisitions, sometimes under the umbrella of corporate finance. And then, just to give you a flavour, you've got what I call, broadly speaking, asset management. Now, asset management covers a wide range potentially of activities, but often it's finding solutions for clients, institutional domains, sometimes retail. What sort of solutions? Well, this sort of thing. A client says, I want a product that guarantees my money back after 5 years and offers 3/4 of the return on the FTSE 100 index in the meantime. So it's like a win-win, isn't it? The client wants their money back in 5 years' time if the FTSE dives, and they want their money back plus 3/4 of the gain of the FTSE if it rises. How's a bank going to organise that solution? Now, don't worry about the technical stuff here, but a bank might say, well, supposing you come to me as a big client with £50,000, maybe what I can do is buy on your behalf a certain kind of IOU, a bond, and a derivative called a call option. Now, before you switch off the video thinking it's all jargon, I'm not so worried about what these things actually are. It's more the principle. This could be a deep discounted bond. So essentially the bank puts £45,000 into the bond, knowing it will mature in 5 years' time at, say, 50,000. So there's the money back for the client, should the FTSE collapse. The call option essentially gives the bank the ability to cash in if the FTSE rises over that 5-year period, to the extent that they can pay the client the 75% of the FTSE's return, okay, and keep a bit back for themselves. And if you're thinking, how does the client lose? Well, in the meantime, the client's not earning any interest on their capital, and they're not receiving dividends from the underlying index. so on and so forth. Plus, they're probably paying a fee for the product. But there it is, a so-called structured product. And I've used a very fast and loose example. There are other ways that product could in practice be created. So there you have it. A quick tour of the role of banks. They're a crucial part of the financial system. And remember, no matter how complex the product, no matter how complex the bank, at the end of the day, they exist to do one thing: bring together people who've got money with people who want money and make as much money out of that process as they can.